Hi, my name is Deon Rebello, and I'm the CEO of DCX Bullion. I'd like to welcome Bruce Williamson for a chat today, and it's quite an important chat. I've known Bruce for the last couple of years, and Bruce is a mining analyst that has given analytics across mining for the last 40 odd years. He's got an extensive CV, but he's going to give you all that information, and we're going to really just break down some interesting things. As we will mention, we will discuss interest rates. We're going to discuss the world where we are right now and where physical bullion specifically can support you in these uncertain times. Good afternoon, Bruce. How's it?
Hi, good day, Deon. Nice to be here.
So, Bruce, I don't know if you want to get straight into it.
Okay, yeah, Deon, let's pick up and move on then. So we'll just chat briefly about the PGM and gold and silver markets. But before I get going, just for all your listeners to understand that this comes with a big disclaimer and a health warning. I work as an analyst fund manager at Integral Asset Management. We are licensed under the FASE Act and registered as a Category 1 and a Category 2 financial service provider. And that means that we are not allowed to give advice to people unless we are mandated to do so. So please, everyone needs to understand this is just a informal chat. It's adding information and sort of a bit of thinking to your clients and people that are interested. It's definitely not advice.
So Bruce, just on that, and we at DCX have always been very big on information because we believe that information equals power. And in the world we're living in right now, with the amount of uncertainty, the biggest problem people are doing right now is they're scared, they're worried, but they're not making actionable decisions. So there's almost waiting for things to happen. Now, I think with what we're going to discuss today is kind of what we really want people to know and decide is to actually start making actionable decisions that can start to negate some of the things that we are about to see coming both economically, globally, and also locally.
Right, Deon. So let's just have a look at probably the most important economic stat that there is globally, which is interest rates. Very topical at the moment, because this will lead into where we sort of go next. Chart I'm showing you now is a 70-year chart on US 2 and 10-year Treasury yields.
Sure.
And you can see up until sort of 1980, interest rates rose strongly to about 15-16%. And these two line charts show that for 40 years, interest rates have capitulated, absolutely collapsed. Now, that has been incredibly bullish for bond markets. Yields fall, bond prices go up.
Yeah.
Yields fall, it stimulates economic activity, and we saw this massive buildup in debt around the world in the last 40 years, be it individuals, corporates, and governments.
Yeah.
And lower interest rates are good for equity valuation. So people tended to completely forget about real assets like gold, silver, and PGMs. Now what we've seen, if you look at the far right-hand side of this chart, is suddenly inflation, supply chain issues have caused a lot of inflation around the world, and everyone's very, very aware that the central banks, led by the Fed, are fighting inflation. And the way they fight it on the monetary policy side is higher interest rates. Yeah. Now, I hear endlessly people saying, oh, but the short-term 2-year Treasury has only gone up 4%, 4.5%. I said, no, that's not 4.5%. It went from 0.1 to 5%. It's now dropped back to about 3.5%. But 0.1 to 5% is up 4,500%.
Yeah.
Now that is scary. The 10-year, you can see, went from 0.5% to 4.23. That is up 750%. So when your cost of funding stuff goes up, those type of numbers, and not everyone's interest rates are going to, because banks will often fix and businesses will hedge, but it's not a little increase. This is a serious increase, and so now people are going to look and see how do they reallocate their assets. Now, I just think either if they keep on pushing interest rates, it means the fight against inflation is not won. People might think more about investing in real assets like precious metals. If interest rates are pushed down, it may choke off economic activity.
Yeah.
To such an extent that people don't want equities because businesses are battling. And that in turn that fear might also play out in the hands of precious metals.
Just interesting, and it was a conversation we had a couple of weeks ago where, in your time as an asset manager, you said to me, it's interesting to see the younger guys who are in their 20s and 30s who've always traded within times with low interest rates. And now suddenly we're looking at a world with higher interest rates and it's foreign to them. And I think what you're also highlighting here is we've lived in a world where we kind of thought, and even with the pandemic and that we'd just the governments, the central banks would print themselves out of these problems. And by creating more money, more debt into the whole system. And now we're coming to see what's really happening and how it's actually affected the economies. And I think you're highlighting that with that.
Yeah, so absolutely. And, you've seen in the last 2 weeks, I think it's 4 banks in the US are in trouble. And they've had to be bailed in or bailed out, whichever way people want to describe it. But it's caused credit stress. Likewise, on a different matter, on a different continent, we've seen Credit Suisse literally within 2 weeks is now taken over and bailed out. My feeling, and when you say people in the last 20 years have been used to lower interest rates and that these are higher, and this is where I need people to think about and differentiate, is that increase from 0.5% to 4% needs to be looked at on a percentage basis. And that's the strain where that water level rises very quickly. And I think people are going to have to get used to that, and it's going to cause stress. What the knock-on effects are might still play out.
Yeah, and I think this is where in low interest rates, and you mentioned it or touched on it, is the biggest problem there is people extending themselves into more debt. And if we look on a personal micro level, individuals have, but so did companies. So did, they would extend themselves further into debt. Now suddenly that debt's becoming more and more expensive to repay. And that's where the problem's coming. And as you say, it's a chicken and egg syndrome, is we need to stimulate the economy, but if people are unable to be paying for these now higher interest-bearing loans, it affects everything. And I think this is where, even from a monetary policy, you've seen that the governments are not 100% even certain where to go next, because they increase it, and then you see the dollar takes a hammering. And then you see a massive increase, and over the last month alone, just in dollar terms, gold's gone up over $150 since the beginning of March 2023.
Yeah, so maybe I think you're quite right. It's more and more questions are going to be begged now because of this interest rate swing, the uncertainty whether inflation can be controlled. And I'm very firm in my mind that inflation cannot only be controlled by monetary policy, higher interest rates. There's also a structural supply problem. For years now, the world has put pressure on the mining world, higher ESG requirements. Now fossil fuels are unwanted. Well, miners have now reduced their exploration. With inflation, new projects are more and more costly. There's a serious technical engineering skill shortage around the world. And so you can't just crack your fingers and boom, and new mines and new supply. So the shortage of supply is also going to mean that inflation is going to be a lot more sticky. And so I guess that's partly the run in the gold price. But so maybe I've got 2 charts on the screen at the moment, and let's have a look what's going on here. Is on the left-hand side are the PGMs, gold and silver, in dollars. That is indexed to 100 in July 1992. And on the right-hand side, it's the same chart in rands. So you can see the CAGR there is the compound annual growth rate. And a starting point is important. You're going to get very different answers depending on when we start this exercise. But I just went back sort of 30 years to see what would happen. So you can see there in dollar terms, platinum up 9.3% per annum, gold, silver 5.9, 5.7, rhodium, and then platinum a bit lower. And we'll come to what's happened to platinum and rhodium. On the right-hand side of the rand prices, and essentially you can add about 6% per annum depreciation for the rand onto those dollar prices. So in rand terms, platinum's done, palladium has done 16.3%, gold and silver above 12%. So those are very respectable long-term CAGR increases.
Well, I know that platinum was the top performer of precious metals last year. It actually had a very solid, but a steady solid growth projection through 2023, and it looks to seem to be carrying that forward. Are there like a couple of underlying reasons why platinum would be starting to look stronger?
All right. Well, let me jump on, or maybe just let me add another slide or two here that I think the listeners would enjoy. What I did recently was to look, and I could sense that although precious metal prices had done pretty nicely and the rand had been weakening, but the prices of the share market didn't seem to quite fully reflect it, i.e. the market didn't quite believe these increases. So this is a very similar chart, but this is now from August 2007. Again, it's an arbitrary starting point. And what I've done here on the left-hand side is the rand price of gold versus the underlying SA-listed gold shares. And that's DRD, Durban Rudapur Deep, Pan-African, Goldfields, Anglo Gold, and Harmony. And what you can see is that indexed again to 100 in 2007 is the rand gold price has actually outperformed the underlying shares. And that includes dividends, so it's on a total return basis. Now, normally you wouldn't expect that. You would expect that if revenue goes up, there's a gearing, leveraging effect to the bottom line, and that the underlying miners would outperform. That hasn't happened, and that's partly because the market hasn't been that certain of how sustainable the increase in the gold price has been. So there was hesitancy. And we'll get to the future of what we think. On the right-hand side, equally fascinating, same August 2007 as the starting point. The rand gold price is up 13.3%. The South African JSE All-Share Index, total return, is only up 9.9. So you could have closed your eyes and the rand gold price would have given you a better return. So let's have a look at what's happened. This is a chart of the gold price and the silver price on the left-hand side. And you can see they kind of move along in a similar fashion, not as correlated as you would think. And then more recently, gold has quite strongly outperformed silver. And what I've got it down on the bottom are two red arrows. One is just to note that during the period 2002 to 2012, gold and silver did particularly well. Now, 2002 to 2007 was a very, very strong market before there was the global financial crisis. So the steep run reflects the crisis. But gold and silver had been doing well prior to that. And I'm just looking now, and I've got the short arrow on the right-hand side, is gold and silver in recent times has started picking up quite nicely. And it's only now in the last few months that we've seen this pressure on the markets by way of the Russian invasion. COVID did play a role, and now inflation. But are we going to look at potentially a replay of what happened 2002 to 2012? And on the right-hand side, I've simply shown is gold divided by silver since 1992, 30 years. And you can see it moves around. I think the one observation is that silver tends to have very sharp rallies, but they often give back the price quite quickly. So it's a bit more sharper in terms of the up run and then a correction.
So, Bruce, what you're essentially saying here is silver is more of a volatile market versus the gold market. We know with that chart that you just showed, that would be the gold-silver ratio, where gold in ounces to silver, they then measure that over the period of time. And as you say, that ratio has extended quite a lot in gold's favor, and then it's pulled back quite a bit. And we see that the ratio has pulled away from silver again, which makes silver in relation to gold cheaper, and possibly also a better buy in the short term. As you say, it tends to rise a lot quicker and fall a lot quicker, so it is a volatile market. And we've always said this to investors, is silver, you not buying it for today and selling it tomorrow. It's a long-term hold. And any of these sharp pullbacks are actually buying opportunities. We've seen gold also marginally in percentage less of spikes and dips. But any of those pullbacks or profit taking in the markets are generally good opportunities to be purchasing the metal.
Yeah, look, I know probably a lot more about the gold market than I do the silver market. And a lot will depend on what's happening out there in the trade. Remember that a commodity like silver, there are hundreds, if not thousands of people that go to work every day just to trade silver.
Yeah.
And if they can make a few bucks and they up at the end of the day, they're going to sell and go home happy. Or if they need to cut losses, they'll probably say, well, thank goodness I cut that loss and go. So there's an immense amount of trading that happens that us in the investment world just don't get to see and hear about. But yeah, I think we just want to show people the charts, show them the trends, what is happening, and then picking between the two. I think that means someone's got to sit down and have a more formal discussion.
Absolutely.
Right. What I also wanted to get to is the PGM market is fascinating, and for South Africans, I mean, we are the kings of platinum, palladium, rhodium supply, and I guess we're privileged in a sense that we've grown up here with the big producers around us. We should know something about this market. So let's just have a look. And often, as time moves, and depending what the fabricators are doing and what the mines are supplying, opportunities pop up as to which of these PGMs you could play. So top left-hand chart is palladium versus platinum. And you can see back in early 2004, palladium had fallen dramatically against platinum. And it sort of held its own and flattened. But from about 2010, palladium has just outperformed. And really that was largely a question of an issue of there was enough supply, and the palladium price was probably less than half that of platinum. And the autocat industry moved out of platinum into palladium. And you can see that runaway. And I think that runaway performance, and in the last 2 years, we've been chatting about the potential for a switch to happen, where you would switch out of palladium into platinum. And you can see now how that has happened. Palladium has underperformed. On the right-hand side, we've got rhodium versus platinum. And we'll get and unpack the supply side shortly, but rhodium just shot the lights out. From 2010, it went from, $5,000 to nearly $30,000. It has now collapsed to $8,500. And one needs to understand the supply dynamics. South Africa is the kingpin supplier of rhodium, and it is mainly used in autocats to negate the harmful nitrous oxide gases, etc. So it plays a very, very important role in cleaning up the industry. Now, what really has happened here is that our South African miners supply to the big auto industry. And this goes back 50 years. They supplied to General Motors, Chrysler, Ford on long-term contracts. And likewise, the Europeans and the Japanese will buy on contract. The guys who don't buy on contract are the Russians. And so I think what has been happening here is that the contracted world, they know that they can get the volumes from our miners. It's a question of what's happening in the spot market and what's happening to prices. But the big Western and Japanese and South Koreans have got contracts. Typically, the Chinese who have come later to the market in their auto industry, they don't have those long-term contracts. So they need to be in the spot market. And you can see with China and their strong COVID lockdown, that hurt things like palladium, it hurt things like commodities like rhodium. And then more recently, there's news out that a big fiberglass entity in China has been selling a lot of platinum, rhodium powders and alloys. Yeah. And, by the way, have announced last week that they're due to sell more. So that has added to big pressure in the rhodium spot market. What we need to watch here is when does China regroup and start coming back. They'll play in the spot market, and those prices could move quite sharply then.
Just on that, Bruce, South Africa is, of the PGMs, we the biggest supplier of platinum and rhodium, as you mentioned. Russia is the biggest supplier of palladium. Do you know, now you raise the thing with contracts and that, with Russia not being in that, would that have actually played against their supply of platinum amongst them also being at war and a number of other things?
Yeah, look, Russia and Nornickel would have been involved in supply contracts, so similar to our guys, and they'd also probably also supplying the spot market. So maybe listeners, I've shown this chart to your people before, but maybe just another good one for an update. Essentially, the table on the left-hand side shows you what are the PGMs in the ground, or what we call the PGM split, i.e., for every ton you mine or every ounce of PGMs you refine, what percentage is platinum, palladium, rhodium, and the others, iridium, ruthenium, gold, etc. So on the left-hand side, you can see by country, South Africa dominates the supply of platinum in the ground. Russia dominates the palladium in the ground, and South Africa dominates the rhodium in the ground. Those are the two big countries that really count. North America and Zimbabwe are useful, but they don't really move the market. And anyway, the South Africans own most of the production in Zimbabwe and North America. And then recycling is always there. But recycling is a very low profit margin business. But the AutoCAD guys will help and take the recycled metal. It gives them guaranteed supply, and they will make money elsewhere. But it's a low profit margin. The right-hand side is the important. So if you look, South Africa, 50% of platinum. Russia's only 8%. So we the kings. Palladium is dominated by Russia, and we are very close second there. And then rhodium, we are number one. So now we need to understand what is going to happen to South Africa's supply. Your question, what's happened to Russia? Russia is a bit uncertain. We don't know exactly how much of their metal is getting out. I suspect most of it, because the sanctions, by and large, have not been strong enough on a lot of vital metals and inputs into the world, but they might have to be selling at discounts. Now, I think what is critical, what happened last week, is Xi Jinping from China went to Russia, evidently spent 3 days there, and that struck me as being, wow, we better take note of that. I suspect that the Chinese are now well aware that mining companies are going to battle to meet the supply needs if and when the economies turn around. and that the Chinese have probably started negotiating and saying to Russia, we need to have more access to your metals, your agricultural products, and to your energy products. And so if more of the Russian stuff starts being tied up into the Chinese network, that plays right into the hands of the South Africans in terms of security of supply. So it's going to be interesting. There's a lot happening that we need to get to grips with here.
Bruce, when you say that, in what way would it play to South Africa's advantage?
Well, China would be able to plan a lot more better and accurately because they know they can get the supplies
From South Africa?
No, from Russia.
Just Russia.
I'm suggesting that they might now do a deal. And as we talk, there's news out there of more and more countries joining the BRICS.
Absolutely.
I don't think that China and Russia would be able to pull Brazil and South Africa into that type of supply agreement. Both South Africa and Brazil have got long-term private sector agreements. But it's just a thought that this whole balance of power might swing a little bit more towards the Chinese side, and let's see what they negotiate there. And then we've got to work out our ability to supply, and then obviously Eskom is going to come into that discussion. But what I also wanted to show your listeners, one, this, let's just step back. This is just simply gold versus platinum. So
in ratio, correct?
In ratio, that's just the gold price divided by the platinum price in dollars or any other currency. It would all be the same. But with the move out of platinum autocats into palladium, platinum has underperformed significantly. It's now half the price of gold. And so that's worth people sitting up and taking notice. So let's actually have a look. The same exercise that I did with gold price and gold shares is, here's an exercise where I've gone back to 2010, indexed it to August 2010. The general 6 platinum group metal basket of price versus the underlying platinum shares. And as with gold, the 6E basket price has outperformed all the underlying shares. Now, again, that's not what you would expect. And my only sort of thought or answer to that is that these rampant prices in palladium and rhodium that we experienced in the last few years, the market never believed it. So by taking the risk of buying mining shares, you never got the type of higher PEs or lower dividend yields. Yeah. Every time a good dividend was paid, the share price went nowhere. No one recognized it. So in fact, it was better to just go and sit and buy the metal. And this is what this chart shows. So going forward, is it going to be that different? Arguably not. We're in a more uncertain, more scary place. And somehow that might play into being invested in metals.
So Bruce, just on that, would that mean within the market, so where you got the buying from central banks of gold and things like that, where the market price is being dictated because of that versus the mining stock?
Yeah, look, I mean, central bank buying is something that's always there. Banks have got gold that they've held for decades. I think the US haven't touched their gold since 1968 type of thing. So you also wonder when the rainy day will come. But as you mentioned at the start, is central banks, and especially like the Fed, can just keep printing.
Yeah.
But it's very difficult to gauge. I think countries like Turkey did a bit of selling when they had difficulties. So they were battling, currency was under pressure, and they could sell their gold.
So if you want to just then go into this, the global supply of platinum and where you see a shortage looming.
Yeah, so let's have a look at this. Friday, I attended the Northern Platinum annual December results, the interim results. And they put up a really nice summary, which I thought that we would use and share that with your client base. And so essentially, this is the way Northern, and I pretty much agree with what they've put together here. So the left-hand side of this chart is, the top line is the global supply of platinum. And the two lines below that, the green line shows the platinum production from our local producers that were in production in 2010. And you can see that their production has fallen dramatically. Basically, all of that production has now been closed down. What we see above that in the sort of yellow gold-colored line is the production in South Africa that was coming, the expansion, increase. That has saved us. And we actually held on nicely. But the dotted line shows where we think we're going in the future, or where at least Northern does. And they've done some really intense research work on the South African situation. So you can see our supply falling. If you plug that into the global line chart above, because South Africa is a big supplier, global supplies of platinum are looking as though they're going to fall. And that begs the question, if the world does recover, where are you going to get enough platinum? And so let's have a look. And you know, one of the other things is that Eskom now is, our mining companies have been able to handle what Eskom's load shedding, or what the mines call curtailment, in an unbelievable fashion. They're just brilliant at negating all these problems. However, if Eskom goes to level 6 in winter, the mines go to level 4. Level 4 and beyond, the mines will not likely put the shift down underground on the vertical shafts, because they won't know when they can get the shift back out. They'll be uncertain about pumps and water, uncertain about ventilation and any refrigeration. And so the estimates are, if we have a bad winter and Eskom goes to load shedding 6, we could lose 10 to 15% of our PGM production. And that's just going to exacerbate.
So from that, I mean, what you're saying is that if there's a demand, the pressure on demand versus the supply, the price of platinum should then start to increase through the winter or over the next 6 to 8 months?
Okay, so the supply side is looking like it's going to tighten up.
Yeah.
The recycling world is very, very tight at the moment. Less people are scrapping cars. People are holding on for longer, so less cars are available. As prices have gone up, prices have come back, so it'll make it a little bit easier for the recyclers to fund and finance their operations. But their supply will be under pressure. Now, the question is demand going to pick up in the next couple of months? And the problem there is what is playing out globally: inflation, high interest rates. But let's just look at the palladium price here. Exact same analysis, except here is Russia is a bit more dominant. So the two lines at the bottom, again, palladium, our pre-2010 production has fell off dramatically. Those operations have been closing. We have replaced it with more, which is the gold line. But our prediction, or Northam's prediction, is platinum, palladium will be under pressure. What this also means is that the AutoCAD industry will be looking at this analysis and give them more reason to move from palladium to platinum. If we look at the top line, which is the global line, now on the right-hand side, it looks a bit more healthy. And that is because at this point in time, Northam are assuming that Norilsk, Nornickel will continue with their expansion projects. Now, given what's happened to Russia, we still don't know the longer-term impacts of the thawing of the permafrost.
Yeah.
The top line is the planned Nornickel production, which boosts palladium. The bottom line is if the production expansions don't come on. So this is what would-be investors need to keep watching really carefully, and let's see which opportunities come from there. If we look at rhodium, South Africa, the kingpins here in terms of supply. Again, green line, production been closing down. Gold line is production that has been augmented by expansion projects. But again, going forward, the dotted lines show that it's going to be tough to keep supplying. We are under serious pressure, and there's a lot of our older operations that are going to have to work hard. That the worse Eskom is, the more difficult it is.
So
and sorry, likewise, just to finish off, the rhodium in terms of the global supply is again dominated by South Africa. So the curve shows losing production.
So Eskom within South Africa and the load shedding is quite pivotal to how we perform over the next 6 to 12 months.
And beyond.
Yeah.
And beyond. I mean, I've had comments from some of these PGM execs, and that they are talking about what Eskom will look like at the end of the decade. So it's a very, very deep hole, and I just have my doubts that the government are incapable of digging Eskom out of the hole. It needs a tremendous amount of private sector help.
Just on that note, has there been renewable energy investment within the mining sector, within the platinum sector and gold?
Absolutely. There's plenty going on. It's the one market in South Africa, the one sector that is just booming big time. The problem is that guys like Northam have invested in a wind farm down in the Eastern Cape. They've got to make sure that power generated gets put into the Eskom grid, and they can take it out at any of their mines. So Eskom still need to have the transmission capabilities. So we need money spent on that to make sure that stays in place. Now, their first project, they managed to get an allocation. But people coming on now, you cannot put more wind and solar into the Northern Cape because Eskom can't cope with the transmission. So, yeah, there's a lot of activity. People are moving off the grid in a big way, which means you got to feel sorry for the poor people left behind on Eskom because they're going to bear big cost increases. Alternatively, to wheel the power around through the Eskom transmission system, Eskom are going to charge anyone who's gone renewable a very big wheeling transmission cost.
Which is concerning. I mean, but it's quite ironic where the mines are investing in the renewable infrastructure, and yet they might not even be able to access it if there is a complete shutdown or with load shedding, as it's termed, that they then don't even have access to what they've invested in.
Yeah, exactly. And so in a way, the private sector are bailing Eskom out.
Yeah.
If Eskom can just look after the transmission side, is the private sector are now paying for the generation. And to make sure that Eskom recoups the money from the lost customer base, they will charge more and more for transmission. And so, yeah, it's a private sector bailout. And that needs to stop at some point in time.
Absolutely.
Sooner, not later. So maybe let's look at auto production. You can see the hit we took from after sort of leading into COVID. And that's also partly because there's been about a 10% move in light vehicles to electric vehicles. Now, people have looked at the electric vehicle growth in the last 3-4 years, and it's like a honeymoon. This is so exciting, and people are just escalating the numbers. And equally so, they're saying, oh, well, that's the end of AutoCats and the end of the PGM market. And I think that's very, very premature in thinking that. So one is, in order to get the general supplies of metals right, chip shortages continue, not as bad as it was. And then you've got to question whether there are adequate and affordable supplies of metals to build all these electric vehicles. Now, there's pressure will come when those subsidies into the EVs are withdrawn. They're not likely to be able to keep those subsidies going endlessly. And then what I'm already seeing is as the battery technology advances, let's say you bought a car that could do with an electric vehicle battery of 100 miles, and suddenly they're on the market for 200 miles. The resale value of your car is gone. You can't give that car away. And equally so, the new buyer is not so sure he should buy a car that can do 200 because he's hearing the next ones can do 250 or 300. So perverse in a way, but the greater the advances in battery technology, the more it's going to hit the EV used car market, and people won't know whether they should be buying. So in my book, this honeymoon period of EVs is probably over, and we're going to see a much more balanced market between internal combustion engines, ICEs, and EVs. And that's sort of my way of thinking of. So don't think that the PGM market's going to disappear. It's going to be here for a while.
And just on that note, with relation to hydrogen, as far as the fuel cells, that technology, I know in previous conversations we've spoken where the EVs, as soon as you go to your bigger trucks, your bigger vehicles, where the range and recharge and weight of the actual batteries becomes prohibitive as far as profits are concerned, to move those cargoes across on those types of trucks. Do you still think that is still a potentially a big market to come? And because platinum would be the biggest gainer of that market.
Yeah, Deon, that's spot on. I don't think anything's changed with that sort of analysis. We can divide the auto industry into sort of two, into the light vehicle. And so you've been able to put a battery, and the whole of the chassis, literally the whole chassis is battery. And that has worked with subsidies and with people that can afford $40,000 to $80,000 for a battery vehicle. And they are fantastic to drive, there's no doubt. I've driven one, it's very exciting and very quiet, incredible. But when you move the battery technology to big trucks and big buses, they're so heavy and so huge that it reduces the load factor and it kills the economics. And so that's where, certainly spurred on by the platinum producers, markets looking at hydrogen, and that looks to be the case, is that it's got a fair chance of building nice demand there. And then you're right, that would be more platinum and iridium will benefit there. So that is still playing. Yep, we need more technology. And just, another point to consider is, if you're driving a light vehicle, electric vehicle with this huge battery pack, if you have a small accident, from what I'm told, is the insurers are not going to run there to just have it fixed and insure. They don't know what impact there might have been to the battery system, because it is so integral to the car. And so we're still going to meet these hurdles, or the EV industry is going to meet these hurdles of light accidents, a bigger accident, how you repair that, the guarantees, and the insurance.
Sure.
Yeah. So it's fantastic start for EVs, but I think the commerciality issues are going to start playing a role.
So you don't foresee that your carbon emitting technologies will decrease? They will still remain for the next probably decade or so, even further.
Yeah, I mean, it just struck me. I'm all for cleaning up. First one that just hates pollution. We need to clean up. There's no doubt about it. But we need to be cognizant that this has got to be affordable. So there is this affordable transition that needs to happen. And it just struck me. I was about a month ago just sitting thinking, and hold on, all these cars use rubber tires. And we all wear the tread down on the tires. So what's happening to those emissions? So I jumped onto Google and lo and behold found a study that recently done in the UK where they were able to measure the pollutants coming off the tires. 1,800 times worse than what is coming out of the exhaust of a European ICE, combustion engine car. The guys have done such a wonderful job of containing the emissions in Europe and elsewhere that the emissions are so low, the air is so clean coming out of the exhaust system. Now you've got to look at and go and decide, well, how dangerous are those pollutants coming off the rubber tires? And surprise, surprise, no one's talking about that EVs use all these tires as well.
Well, that's what I was going to highlight.
I mean, it's just bizarre. People are not thinking. There's so much jumping on the bandwagon of this energy crisis, the global climate crisis. We need to think a little bit more deeply about this.
So, but I think what you're also saying is ultimately the technology through the AutoCAT and your natural combustion engine will become more efficient and less carbon emitting. But you're raising something very interesting. I've never actually thought of it as far as the tire pollution, and maybe that's something that needs to be highlighted, because all the EVs have rubber tires. Everything has rubber tires. So it is a massive, massive concern.
Yeah, and they all fossil fuel based.
Yes.
So I mean, if the world had to actually just think about it and just do some general reading, is the amount of products that are fossil fuel based. If you did away with that tomorrow, sorry, we wouldn't function. So, people are being very, very selective by digging in at specifically oil, gas, and coal. Let's clean it up. And the lessons learned is the PGM industry and the auto industry have done an enormous amount to clean up the emissions out of light vehicle cars. Now we need to pay attention to things like tires.
Just on the PGMs, if you can maybe give a medium term outlook as to, just a summary of what we've discussed with regards to all the PGMs.
Okay, so I think the listeners might have got a feel is that platinum being under $1,000 versus the others is starting to look relative to palladium in a good space. So that's probably going to be the one to watch. Rhodium, you cannot avoid it in tidying up the NOxes in the emission systems. That I think when the Chinese selling is out of the way and when China's economy now starts moving again, that's one to watch. On the demand side's actually difficult because we don't know if the Fed, the ECB, the Bank of England and others, if they're going to keep pushing interest rates hard to reduce inflation, there is a very, very big danger that they just tip the economies into recession. And then the demand side weakens. So the next 6-12 months is incredibly difficult to gauge exactly what's going to happen. So people need to sit tight. However, my thinking is that if they can't control inflation, people are going to want more and more real assets by way of PGMs and gold and silver. If they overkill the market, okay, it's going to hurt, but again, that's the real asset play. Otherwise, they're going to drop interest rates. And that's a signal that they've given up on the fight of inflation. They don't want a credit crunch. They're scared of monetary issues. And that's another reason that people might want real assets like gold, silver, and PGMs. So we're in this very, very difficult space, but I just think somehow that both scenarios kind of support precious metals for now.
And you know, when you mention precious metals, again, from a hedge to uncertainty and economic uncertainty specifically, that's where silver and gold really do come to the fore as far as wealth protection over this period of time. And we see their performance, as mentioned earlier, that they've shown that they definitely are on the up. And to say where the price of gold will be by the end of this decade, it's going to be interesting. I mean, the most conservative, and we do a lot of research in this, is CPM, which are the owners of the COMEX in the US. And their estimate was around $2,200 or $250 an ounce. And that's exceptionally conservative. And they are generally very conservative on their projections. So you can take that as your baseline, and you could probably work for probably 30-40% above that.
Yeah, look, I mean, you know, it just depends how fearful and how difficult things get in global economies. And remember that we have got, anyone who's followed Ray Dalio's forecasts, he has been absolutely clear in insisting that the hegemony that the US have enjoyed is being challenged by China, and we're seeing it playing out daily. And so that geopolitical tension has implications for, as we were discussing earlier on, is for the big build-up of more BRIC-type countries joining there. And you just don't know when that type of fear uncertainty unravels. Investors just start buying at any price. So, boy, I wouldn't try and forecast where it's going to go, but you can see the motivating factors here.
Yeah.
And I mean, another motivating factor has been the big rush into crypto-type currencies. With no track record, no history, no certainty, that would you go and sign up and work for a month knowing that you're going to get a cryptocurrency at the end of the month, and you wouldn't know what you're going to be able to buy with it. So it might have a role to play here and there, but it just shows you that either people were just playing games and they had too much money and they were playing, but even the money that's gone into cryptos kind of says that people were looking for an alternative.
Yeah, they try to term, and I don't know a lot about cryptocurrencies, but Bitcoin was the digital gold. Unfortunately, to be honest, cryptos react more like silver, where there's massive highs and massive lows, because again, it's a smaller market. We know gold on a daily basis is traded in the trillions of dollars. And those smaller markets, you know, to have a sizable amount of money coming in or out will determine how those markets rise and fall.
Yeah, look, I mean, gold's, you know, paid its dues. It's been around for thousands of years.
As long as we've been trading.
And before.
Yes.
And so it's paid its dues to the extent that central banks happily hold gold. So you reasonably know if you went to work for a month and someone said, I'm going to give you an ounce of gold, you kind of know what you're getting and you know what you're able to buy. Cryptos haven't reached that level of certainty and trust. So, but I just make the point that people were willing to go into cryptos.
Yeah.
Something says that there was concerns about paper money, fiat money.
Absolutely, and I think maybe that's what you're highlighting here, is there's a concern about fiat currencies, and that's the dollar, the rand, the pound, and so on. And there's been a definite look, and there's also a belief that we're moving into a digital currency of some sort, a global digital currency. Now, you got some of the people like the Robert Kiyosakis who I love him, and don't get me wrong. I mean, everything that the man's spoken about through the years has been very on point. But, you know, we as a business always say we love Robert Kiyosaki, but he calls a market crash every single week. At some point, he's going to get it right. But again, it's those things. Is, you know, there's that uncertainty that's coming through, and it's just interesting to see that, you know, the likes of like a Ray Dalio, and I've also followed him for a number of years. I think where he's starting to show the massive front-to-front confrontation that's becoming more and more evident is between China and the US.
Yeah.
Now, two of the biggest economies on the planet. And the alliances that you've highlighted being the BRICS nations and Russia forming a very critical part of the BRICS nations shows you that there's a fronting off, and there's a definite uncertainty that's been placed even more upon the global markets, upon everybody. I mean, you ask any good analyst what they predict to see in the next 12 months happening, or even the next 6 months, and you will not have anyone with sheer certainty other than Robert Kiyosaki, because he knows it's coming. But, you know, seriously, there is a concern. And we know that the uncertainty has generated, for the average man in the street, a lot of mass uncertainty. We look in South Africa, we've got a number of issues that plays even into that more. We've got a rand that is devaluing, and it's going to continue to fall. And it was lovely that you showed those charts on the difference based on the dollar performance and then the rand performance, where you can see that clear difference in the growth. If you had your wealth in gold, how you negate the devaluation of your money being in a fiat currency such as the rand.
Yeah. No, absolutely. And, you know, as you said, I mean, we've got, South Africa's got added issues to deal with. And they are very, very complicated and difficult. And I just see very little political will and ability. And coalitions are going to be equally difficult to manage. So that talks to what may or may not happen to our rand. But just globally, as we've kind of tried to outline here, is from a supply side, South Africa and Russia, there's issues. Production comes out of Zimbabwe. They battle to get the cash out of Zimbabwe. It's a wonderful place to work in, but currencies are a big problem. So there's a problem. So the supply side talks to a tightening. The demand side, either we settle down and economies roar ahead, well then that's fantastic, great demand, or this whole tension between the US and China, with BRICS fighting the G7, that gets worse, more uncertain, and then people want real assets.
Bruce, I'd really like to thank you for coming on today and really explaining this, but just a summary of what you feel about precious metals and some of the key factors that the man in the streets needs to maybe be paying attention to.
Yeah, well, I think we've outlined it. One, the supply side. Both South Africa and Russia are kingpins, and both have got big problems and issues. So that's supportive of higher prices. The geopolitical tension that's playing out, that in my mind is supportive. The danger is, the negative is that interest rates get pushed too high for too much longer, and we just cause demand destruction. Everyone suddenly, I can't pay my bills, no more new cars, no more jewelry, industrial demand dries up, and then we're in for a crunch. Whilst that is happening, it may prompt people to run for the safety of real assets like precious metals. So almost on 3 out of 4 counts, you can say, hey, maybe not a bad idea to have some money there.
Absolutely. Thanks for your time, and look forward to chatting to you again.
Yeah, thanks, Deon.
Thanks, Bruce.